Greetings everybody, welcome back to Accounting 1101. We are at our final video in our fixed asset unit here, and one question left to answer. We've done all kinds of work already. We have one final thing to look at. What happens when we get rid of a fixed asset? Maybe we discard it, maybe we scrap it, maybe we sell it off to somebody else. But at the end of the life of that asset, when we get rid of it, what happens from an accounting standpoint? Now go back to Kings Island. We've used our Kings Island example so many times during our unit on fixed assets here. And so a tale of two coasters at Kings Island, for those of you who are familiar with the park, there used to be a ride there called Vortex. And Vortex was a steel roller coaster. It took you through all kinds of different loops and inversions and everything. And it was basically a concussion machine. As you got near the end of the Vortex life there, they had these bars that came down over your head, and the entire ride you basically spent with your head bouncing back and forth off of the bars. And so they ended up tearing down the Vortex a couple years ago, I think in 2019, I think it was, and they got rid of it. When that happens, when you get rid of an asset, whether you scrap it or sell it, you've got to get it entirely off the books. And so in Kings Island's accounting records, they would have had to have made some accounting entries to remove the Vortex and all of its depreciation off of the books. They don't have it anymore. Let's compare that to another roller coaster that you can still ride, the Beast. It's a classic. Me and the Beast were born on the same year, so we kind of go way back. But the Beast, obviously, if you're looking at a 20-year life, is fully depreciated. Me, I'm fully depreciated too, and have been for quite some time. But the Beast is fully depreciated, and has been for a long, long while. But it's still going to be on the accounting records, even though it's fully depreciated. They're still using it, and so it's still going to be reflected in that cost number on their balance sheet under rides and equipment. Okay, so the idea here is as long as we're still using the asset, we keep it on the books, even though it's fully depreciated. Okay, there's no law that says we can't continue to use an asset even after it's depreciated fully. We can still use it. It remains on the books until we get rid of it, like we got rid of the Vortex. So how would that look? We get rid of the Vortex, we got to pull that off the accounting records. As a fully depreciated fixed asset, it's pretty straightforward if we're just discarding it and we're not getting anything in return. As you can kind of see here, I've got the financial statement effect going on. 2019, in October, when they got rid of the Vortex, they would have made an entry to the equipment account, crediting it to get that $4 million off of the books. They also would have made a debit to accumulated depreciation to remove that amount from the books. And so it's like Vortex never existed on the financial statements at that point. You can see the financial statement effect. Equipment goes down $4 million, and that depreciation that was attached to it also goes away. And so it kind of washes out. It's gone. If a fixed asset was not fully depreciated, we record a loss on that disposal to kind of balance out the entry. But if it's fully depreciated, it's actually pretty simple. We just got to take it off of the books. So if we sell it, it's a little bit more complicated because now we've got to do some accounting for what we have coming in the door. Normally some amount of money. And so kind of three things we got to tackle here when we sell a fixed asset. And again, you don't have to wait until the very end of its life to sell it. We can sell a fixed asset at any time we want. So if we look, our three steps right here, we'd have to remove the fixed asset and all the accumulated depreciation on that asset. We don't have it anymore. We got to get it off the books. Second part, we have to record what we got for the fixed asset. What amount of money did we get when we sold it off? And then finally, if that selling price that we got is different than the book value, we need to record a gain or loss to kind of balance out our accounting transaction. Remember, debits have to equal credits. So that last part there, the book value, we've talked about that a little bit. Hopefully you know book value at this point. Maybe pause and think about it and see if you can write out the calculation for that. Our calculation for book value is our cost of what we paid, historical cost of the asset, minus what we've depreciated. So if our selling price is different than that book value, we either have a gain if the selling price is more than the book value, or a loss if our selling price is less than the book value. We have to plug that in to kind of make that transaction balance out. So let's take an example here. Assume we have equipment that we bought for 10,000 bucks. It has no estimated residual value, and we depreciate it straight line at 10%. 10-year life, 10% a year. The equipment is sold for cash on October 12th in the 8th year that we're using it. The balance of the accumulated depreciation account as of the preceding December 31 is $7,000. Okay, so we're kind of getting near the end of the life of that asset. We only have about 2 more years left on it to depreciate it. We're going to go ahead and sell it. And you'll notice we have a little partial month hanging out there where we got rid of it on October 12th. And so we didn't get rid of it at the end of the year. We're going to have to account for that. And in fact, that will be what we do to kick off things. We got to record what we depreciated from January to October 12th. If you remember back in our partial year video, we showed you the calendar of when we would consider things bought, even though it was bought during different days of the month. And we said that if it's bought between the 1st and the 15th, we consider it having been bought at the beginning of the month. If you don't remember that, go back and look at that video. But the exact same idea here. We sold it off on October 12th. Even though it's on the 12th, we're going to go back and assume it happened on the 1st of the month. So we need to record what we depreciated January, February, March, April, May, June, July, August, September. All kinds of fingers I'm about out. 9 months is what we're depreciating here. January through the beginning of October. Okay? So really January through September, because October, we're assuming that we got rid of it at the very beginning of the month. So 9 out of 12, 75% of the year. So what is our normal amount if we had a full year of depreciation? You see we had $10,000 of a cost, no residual value. We're depreciating 10% a year, 10-year life. So $1,000 a year is what we're depreciating. So we take that 75% and multiply it by $1,000. In that final year of disposal, we would depreciate it $750 to reflect that amount of time that it depreciated from January through September before we got rid of it on October 1. Step 2, we'd have to calculate the new book value because we just depreciated it a little bit more. We had $7,000 in accumulated depreciation at the beginning of the year. We just added an additional $750 to reflect the 9 months that we had it in the current year. So our new accumulated depreciation would be $7,750. We paid $10,000. Our accumulated $7,750. The difference between the two would be $2,250. That's our new book value. So now we're ready. We can look at a few different scenarios that we're going to sell off that asset that has a book value of $2,250. I'm going to show you what happens if we sell it for an amount the exact same as the book value. I'm going to show you a higher amount that we sell it for than book value, and then a lower amount that we sell it for, just to kind of show you how the accounting works in every scenario. Okay, so keep in mind, 3 different scenarios here for this asset based on that book value. Here's scenario number 1. We're going to sell it at book value. The equipment is sold for cash on October 12th for $2,250. That's our book value. So no gain, no loss here. We're selling it at book value. From an accounting standpoint and a financial statement standpoint, we're adding cash into the mix because we sold it for $2,250. Cash is going to be added. We're going to remove $10,000 worth of equipment, right? Because that equipment, we no longer own it. We don't have it. We got rid of it. It has to come off the books. $10,000 gone. We're also going to remove the related $7,750 that had accumulated in depreciation. Because the equipment's gone, the depreciation tied to it no longer needs to be on the books either. So if we look at that, you can see $2,250, $7,750 is $10,000. We removed $10,000. So our entry's going to balance. We don't have to worry about booking a gain or a loss in order to get our entry to balance, because the book value is equal to what we got. So our journal entry to do that, we'd have a cash debit. Cash is coming in. We get rid of the accumulated depreciation. No longer have the equipment. We get rid of the equipment. Debits equal credits. From a financial statement framework standpoint, our cash is right there. Cash went up. Our equipment went down. And the associated depreciation went down. We'd include that on our statement of cash flows because we added $22.50 in cash. That is the easiest scenario because we have no gain, no loss. But what happens if we do sell at a little bit of a loss here? We can see in this example, it says the equipment is sold for cash on October 12th for $1,000. Now, we need to kind of say a little different here up at the top because I've got sell price equals book value. In this case, my sales price will be less than book value. Little correction there for you. So exact same scenario, only now we're selling it for $1,000 instead of $22.50. We're adding $1,000 in cash. We're still getting rid of the equipment, removing it. We're still removing the depreciation on the equipment, but now you'll notice our numbers don't balance out there. We have $8,750 on one side and $10,000 on the other. So we'll have a loss in that scenario because we sold it for less than the book value. The book value was $2,250. We only got $1,000. So we have a loss of $1,250. Looking at it from an accounting standpoint, you can see our journal entry here. We collected $1,000 in cash when we sold it. There's our depreciation going out. There's our equipment going out. That loss right there is a plug to make it balance out. Difference between what we sold it for, $1,000, and the book value. And you can see all that up here. That loss is reflected in retained earnings. Hit to retained earnings. It's showing up on the income statement as a loss. And then there's our cash coming in on the statement of cash flows and on the balance sheet. Equipment goes down and the accompanying depreciation is also going away. So one more scenario. Our final scenario, our sell price is greater than book value. We got to do some editing on these PowerPoints. Sell price is greater than book value. Instead of $1,000, now we're selling it for $2,800. I'm getting cash in the door, $2,800. We're getting rid of the equipment. What we've depreciated, we had book value of $2,250. Again, we've seen that number a few times now. But we sold it for $2,800. We sold it for more than the book value. We have a gain. So now we'll book a gain to balance out our transaction. You can see that right here. Cash coming in, $2,800. We get rid of the equipment, what we depreciated. And there's our gain on disposal in that journal entry. Gains work like revenue. They go up on the credit side. We plug in that $550 right there. You can see on the financial statements, we're adding to retained earnings to reflect that gain, which is similar to revenue. Also on the income statement, we're adding $2,800 in cash and on the statement of cash flows and say goodbye to that equipment and the depreciation. So it's a little bit involved, a couple of different moving parts there, but nothing that I don't think you all can't handle with a little bit of practice. So where have we been? What a marathon, right? Fixed asset accounting. We've calculated the cost of a fixed asset. We've done straight line, DDB, depreciation calculations on those. We've done a partial year example where we bought the asset in the middle of the year instead of at the beginning. And now finally, we've gotten rid of a fixed asset. We've disposed it, we've sold it, and really it's the fixed asset cycle of life. Hakuna Matata, right? If you have any questions on that as you're doing your homework, hopefully we prepared you to do the homework problems now. But if you do run into any issues, I'd be happy to help. Reach out, look me up, and we'll try to help you along. We do have another chapter that we need to tackle, and we'll come back for those videos next week. We'll see you all then.